Market efficiency is always tested jointly with a model of market equilibrium, but the converse is also true. Common asset pricing models, like the capital asset pricing model of Sharpe and Lintner, developed in the mid-1960s, Merton's intertemporal CAPM, and the consumption CAPM of Lucas and Breeden from the late 70s, assume that all information is costlessly available to all market participants who use it correctly in their portfolio decisions. In other words, they assume a strong form of market efficiency. Thus, tests of these asset pricing models jointly test market efficiency. The second part of this section on capital markets is about event studies. So in the initial empirical work on market efficiency, the test centered on predicting returns using past returns. In a 1969 paper that I co-authored with Larry Fisher, Mike Jensen, and Richard Rowe, extends the test to the adjustment of stock prices to the announcements of corporate events. In the FFJR, the event is stock splits. But the impact of the paper, the long-term impact of the paper, traces to the empirical approach it uses to aggregate the information about price adjustment in a large sample of events. Like other corporate events, the sample of splits is spread over a long time period, in this case 1926 to 1960. To abstract from general market effects that can obscure a stock's response to a split, we use a simple market model time series regression. That's this little equation here. So in this equation, RIT is the return on a stock that splits its shares, not necessarily a month T, but this is just the return on a stock. This is a constant, this is a constant, this is the market return, and this is a residual. Now what these two terms pick up is the average return on the stock and its normal response to the market. Everything else goes into this term. So the effect into the residual term. So the effect of the split on the return shows up in the residual. And the tests focus on examining the properties of those residuals. Now the cute little insight that we had was if you really want to aggregate this information across all of the stocks that experience a split, you change the way you measure time. So you measure time relative to the event. So time zero, we only had monthly data at this point. Time zero is the month when the split occurs. Time minus one is the month before that. Time plus one is the following month, and so on. So what we did was we averaged these residuals across, I think there were 670 splits, in event time. So we get the average residuals, 30 months, we went to minus 30 to plus 30, from 30 months before the event to 30 months after the event. And we looked at those average residuals, and we also examined the cumulative average residuals. So we just cumulate that series of averages. Let me put up the. So this is the striking picture that emerged from that study. This is the plot of the cumulative average residuals from 30 months before the split. This is the split month here, and this is up 30 months after the split. And these are averaged across all of the 670 companies that did stock splits in this time period. So you see this is the path of what happens in advance of the split. So you see this cumulative going straight up. So what it says quite obviously is that companies split their stocks after they've experienced good times. And that's easily documentable in terms of dividends, earnings, and that stuff. Now, it looks like you can make money on this. Well, you could make money on it if somebody told you the split was going to occur. That would be really valuable information. But you don't know that until it's announced, and it's not announced until very near the event. But what market efficiency says is all the information that implies should get into the price at the time when the information comes out, which is time zero, and thereafter it should be just random. And that's exactly what you observe here. This is incredibly flat after the... So there's no more price adjustment, despite the fact that 75% of these companies continue to have good times in the years after the split.